Welcome to the Deep Dive, the show that's really built for the learner. We take some of the most complex intrinsic value analyses out there, we stack up all the source material, and we try to give you the definitive shortcut to understanding the businesses that, well, truly define the global economy.
And today, we are opening up the hood on one of the most powerful, most consistently high-quality businesses in the entire world.
That's right, we're talking about Mastercard Incorporated, ticker MA.
And this specific deep dive, it's really custom tailored for you, for the person who wants to understand how a true Tier 1 compounding business actually operates.
So we're applying the rigorous investment framework popularized by Warren Buffett.
Yep, which means we are prioritizing just three things: pristine business quality, the sheer durability of its competitive advantage, what he calls the economic moat, and of course the certainty of its future cash flows.
And our sources call Mastercard the toll bridge to the global economy, which I think is a crucial metaphor. I mean, they process billions and billions of transactions every single day. They're sort of the unavoidable switch for commerce.
But that brings us to the central conflict we need to address right away.
Okay.
While the business quality is, it's undeniable, the analysis shows they are consistently generating a jaw-dropping return on invested capital, or ROIC.
Which is exceeding 40%. It's just a huge number.
That's a huge number. But the initial verdict is that the current market valuation reflects what the sources politely term immense optimism.
Priced for perfection, in other words.
That's it. It's the classic challenge of value investing, right? Finding a phenomenal business at a sensible price. And Mastercard is, without a doubt, a platinum standard business.
But based on where it's trading today, the analysis suggests it's just not there on price.
Exactly. So our mission today is to show you why this business is so exceptionally good, to find the only things that could really stop it, and, ultimately, determine the specific price that would finally offer a required margin of safety.
So let's unpack this business model first, because I think the way they make money is fundamentally misunderstood by almost everyone.
I completely agree. Let's start right there.
So when you hear the word Mastercard, what do most people assume? They think Mastercard is a bank, right? Or that it's the company lending them money for their credit card.
And that couldn't be further from the truth. Understanding this distinction is really the key to understanding all of Mastercard's power.
Okay, so break it down.
Mastercard is not a bank. It assumes absolutely zero credit risk. It doesn't hold any consumer debt on its balance sheet. Nothing.
So what is it?
Its core identity is that of a global technology utility. It's a massive, sophisticated digital network. Their product is data movement, authorization, and security.
So if they aren't lending the money, what exactly are they doing? They built the rails, but how does the transaction actually flow?
They operate what's called a four-party payment system, and they are the central switch.
Okay.
So think of a simple transaction. You, the cardholder, you go to buy something at a merchant, online or in a store. That data doesn't just flow directly from the merchant to your bank.
Right, it has to go somewhere first.
It has to go through this rigorous, instantaneous process.
So walk us through those four parties.
Sure. First, you have the cardholder. That's you and the merchant. Simple enough.
Okay.
Second, the merchant's bank, which is called the acquirer, collects the transaction data. Third, that acquirer sends that data through Mastercard's network.
The switch.
The switch, exactly. And that switch connects it to the fourth party, which is your bank, the issuer.
And my bank, the issuer, is the one that says, yes, you have the money, or no, you don't.
Precisely. The issuer authorizes the transaction based on your credit limit or your bank balance. Mastercard's entire job is just to make sure that handshake happens instantly, securely, and globally.
And then they handle the boring part, the settlement of the actual money later on.
Yep, clearing and settling over the next 24 to 48 hours. And for providing that critical, non-negotiable service, they extract this sort of royalty-like fee.
That's the toll bridge analogy come to life.
It is.
And crucially, that fee isn't just one single charge. The analysis breaks down their revenue into, three primary pillars plus a fourth growing one.
That's right. Let's tackle the ones that depend on volume first.
Go for it.
So the first pillar is domestic assessments. This accounts for about 28% of their total revenue.
Okay, and what are those?
These are fees charged to the banks, both issuers and acquirers, based on the gross dollar volume, or GDV, that moves on Mastercard rails within a cardholder's home country.
So this is tied directly to how much people are spending. If Americans spend more on their cards this year, Mastercard's revenue from this bucket goes up no matter how many individual swipes it took.
Exactly. It's purely a dollar volume play. Then the second pillar is transaction processing.
And this one's bigger, right?
Yeah. This is the largest single segment, sitting at about 34% of revenue. This is the fee charged per transaction for switching the data, the authorization, clearing, and settlement services we just talked about.
So the key driver here is that big secular shift from cash to card.
Exactly. Every time someone uses a card instead of cash for something small, buying a coffee, a bus ticket, that adds to the transaction count, and Mastercard collects a tiny fee.
And then there's the segment that analysts always seem to call the crown jewel, the really lucrative one, cross-border volume.
Right. And this pillar is a bit smaller in contribution, around 23% of total revenue, but it historically carries the absolute highest margins.
And the fee here is earned when the merchant and the bank are in different countries.
That's it. So think international tourism, global business travel, or just cross-border e-commerce. They charge a premium for facilitating the currency conversion and for handling all the added complexity of settling funds across different regulatory systems.
As global travel roared back after the pandemic, this must have been a huge tailwind for them.
A massive turbocharger for their revenue growth. It often grows twice as fast as the domestic volume.
So if you, our listener, have ever traveled abroad and seen that foreign transaction fee on your statement,
You know exactly what we're talking about.
you hate paying it, but Mastercard loves collecting it.
And those three pillars combined, domestic volume, the number of transactions, and that high-margin cross-border business, they're all tied to global commerce. Which brings us to the key insight of why this is such a powerful inflation hedge.
Okay, this is where we need to slow down because this concept of massive operating leverage is so important. How does inflation automatically drive up Mastercard's revenue without them really doing anything extra?
It all goes back to that first pillar, the domestic assessments, which is tied to nominal spending.
Not real spending, but the sticker price.
Right. So let's imagine a period of high inflation like we've seen recently. If the price of everything you buy, gas, groceries, your utility bill, jumps by, say, 10% this year just due to inflation.
Okay.
When you swipe your card for that now more expensive grocery bill, the gross dollar volume on Mastercard's network also jumps by 10%.
So the assessment fee they charge, which is a percentage of that inflated dollar amount, also goes up by 10%.
Precisely. And here's the magic of the model. The cost for Mastercard to process that now inflated transaction. It remains measured in fractions of a penny.
Their costs don't go up.
Not really. Their cost structure is predominantly fixed. Data centers, core software, their people. They do not need to buy more physical inventory or build a new factory just because the price of milk went up.
The cost to move the data is basically the same, whether the transaction is for $50 or $500.
Exactly. This disconnect between automatic revenue expansion, which is tied to nominal GDP and inflation, and their basically negligible marginal cost growth is what creates that massive operating leverage.
So that extra 10% in revenue from inflation just drops almost entirely to the bottom line.
It falls right to the operating line, translating directly into better margins and more robust intrinsic value growth. This is the absolute hallmark of a truly capital-light compounder.
And it's why Buffett-style investors just love these businesses. They're so defensive against the rising costs that just crush traditional industrial companies.
The economics are incredibly compelling. But in value investing, profitability, it means nothing without the durability of that competitive advantage.
So now we move to the moat, the fortifications Mastercard has built to make sure no one can just come in and build a parallel road right next to theirs.
Buffett famously said the most important decision is judging how durable that moat is. And Mastercard's moat has, it has three massive reinforcing layers.
Let's dig into the classic first layer, the network effect. This is that virtuous cycle that protects them.
Right. The strength here is just inherent in the structure of this two-sided market. It's a self-reinforcing loop that becomes exponentially stronger with scale.
So the network becomes more valuable to merchants as more of us carry a Mastercard.
And conversely, the network becomes more valuable to you, the consumer, as more merchants accept it. You demand universal acceptance, and merchants demand universal coverage. It just feeds on itself.
It's the ultimate chicken and egg problem, and they solved it decades ago, creating what is now just an insurmountable scale barrier.
The scale is absolutely staggering. Our sources confirm that as of 2025, there are over 3.5 billion Mastercard and Maestro branded cards in circulation globally.
3.5 billion.
And you combine that with acceptance at more than 100 million merchant locations worldwide. So a potential competitor, a startup, would need billions of dollars, a decade of time, and just the logistical nightmare of convincing millions of banks, billions of users, and 100 million merchants to all adopt a new standard at the same time.
It's practically an impossibility.
It really is.
And we don't even have to take their word for it. We've seen this durability validated by the biggest, most cash-rich tech giants on the planet.
That's probably the strongest external validation you could ask for. If anyone could afford to spend 10 years and hundreds of billions of dollars to build a truly parallel payment system, it would be Apple or Google.
Right. But what did they do?
They chose to partner. I mean, Apple Pay and Google Wallet are brilliant front-end technologies, but they simply integrate seamlessly with the existing proven Visa and Mastercard plumbing.
They realized it was strategically cheaper, faster, and way less risky to just pay the toll than to try and build a competing road.
Exactly.
So the second layer of the moat is the structure of the market itself, what the sources call the rational duopoly structure. We're talking about the relationship between Visa and Mastercard.
Right. Outside of China's UnionPay, it is basically their game.
So this is where you see the power of that market structure. In the US, Visa is the bigger player, processing maybe 60% of credit card transactions.
And Mastercard handles a very significant 25% to 30%. But what's critical is the behavior of these two dominant players.
Right. So why don't they just get into these destructive price wars? Why doesn't Mastercard just slash its fees by 50% overnight and try to steal all of Visa's market share?
Because it would destroy the economic viability for both of them without gaining any kind of corresponding permanent advantage. Merchants have to accept both Visa and Mastercard to serve their full customer base.
So if a merchant only accepts Mastercard, they're turning away every customer who only carries a Visa card.
And vice versa. They are both, for all intents and purposes, essential utilities.
So the very existence of the duopoly means they both get to maintain immense, almost perfect pricing power because the merchant simply cannot afford to choose one over the other.
That's exactly right. They compete vigorously, of course, but they compete on things like technology, fraud detection, value-added services, not on their core transaction fees. And this stable, rational structure allows both of these giants to maintain those extraordinary margins we saw earlier.
It's an economic paradise for them.
It is.
So the third layer of the moat focuses on their direct primary customer, the financial institutions, the issuers, the banks. This is where high switching costs lock them in.
This is the operational lock-in. For a massive institution like a Citibank or a JP Morgan Chase, migrating an entire portfolio away from Mastercard is a colossal undertaking.
I can't even imagine.
We're talking about reissuing tens of millions of physical and virtual cards, updating all the legacy internal risk management systems, rewriting software integration points, retraining thousands of employees.
It sounds like an operational nightmare, and that's before you even factor in the risk of messing things up for your customers.
It is prohibitively expensive, it's time-consuming, and it carries massive reputational and operational risk. The bank's CIO would have to justify a project that costs billions and carries a high risk of failure, all to potentially save a few basis points on fees.
So they just don't do it.
They just don't do it. The issuer retention rates are exceptionally high. Banks simply do not switch networks unless something absolutely catastrophic happens.
And when we contrast this with a competitor like American Express, the power of Mastercard's model really shines through.
It's a great comparison. American Express operates what's called a closed-loop model. They are the network and the issuer. And crucially, they take on the full credit risk.
So when a recession hits,
Amex's business model is very cyclically vulnerable because their credit losses can soar. Mastercard, however, maintains that pristine capital-light model. They avoid the volatility of consumer lending entirely by leveraging the balance sheets of thousands of partner banks worldwide.
their moat is just pure technology and network. It's isolated from the ups and downs of the economy, which is a fundamental part of their quality.
Exactly.
So we've established the foundation, a capital-light, highly profitable duopolistic network protected by immense scale and lock-in. But the sources note that management isn't just sitting back and enjoying this. They're enacting a really profound strategic evolution, moving from being a pure payment rail to more of an intelligence network. Why are they making this expensive pivot?
Management is keenly aware that while the core network is incredibly profitable, pure transaction processing faces two, let's call them existential, long-term risks.
Okay, what are they?
One is potential commoditization from new technologies.
Mm-hmm.
And the other, more pressing one, is regulatory pressure aimed at capping or driving down those core interchange fees.
So to fortify the business for the next decade, they are proactively building a third unregulated services moat right on top of the existing network moat.
That's the strategy. If they diversify revenue away from those heavily regulated transaction fees and into unregulated, indispensable services, they are strategically insulating the company from political whims.
And this pivot also makes those switching costs for banks even higher, even more prohibitive.
Absolutely. If a bank switches networks today, they might lose a little margin. But if a bank switches networks 5 years from now, and all these services are deeply integrated into their core operations, the operational danger of decoupling becomes, well, astronomical.
So let's look at the quantitative evidence, because this isn't just a story they're telling. The value-added services, or VAS segment, is now a massive material revenue stream.
It is. VAS now accounts for nearly 39% of net revenue. That is a substantial growing portion of a, $31 billion revenue base. This isn't some small pilot program. It's central to their future.
And the growth differential tells the entire story of this strategic shift. How fast is the services segment growing compared to the core network?
The difference is stark. In the third quarter of 2025, the core payment network revenue grew by a very healthy 12%.
Still great growth for a company that size.
Very good. But the VAS segment surged by a remarkable 25% in that same period.
Wow.
That differential growth rate is the proof that their strategy of successfully cross-selling these high-margin, sticky, non-regulated services to their existing partner banks is really working.
So help us visualize how these services create that deeper institutional lock-in, that stickiness. I mean, what are these services specifically?
They create what we call operational dependency. So imagine a large global bank. They aren't just using Mastercard to authorize transactions anymore.
They're using a whole suite of things.
A full suite of services integrated into their core technology stack. For instance, they use Mastercard's proprietary AI fraud detection service called SafetyNet.
Okay.
It monitors billions of data points in real time, instantly flagging anomalies that could signal a huge system-wide fraud attack. They might also use Mastercard's platform SessionM to manage their customer loyalty and rewards programs.
So if that bank tries to decouple from Mastercard's core payment rail, they aren't just looking at losing a fee structure, they're looking at losing the critical intelligence tools that protect them from multi-million-dollar fraud losses, and they lose the platform that manages their most important customer relationships.
Exactly. The risk of operational failure instantly outweighs any minor cost saving they might get by switching networks. It is a brilliant strategy of creating institutional lock-in that goes far beyond just being a simple network utility.
And we saw definitive proof of this commitment to the services moat with their acquisition history, particularly the purchase of Recorded Future back in 2024.
That $2.65 billion acquisition was a clear, definitive signal. Recorded Future is a cybersecurity firm, so Mastercard is explicitly moving beyond just securing a transaction to securing the entire digital ecosystem of its partner banks.
They're becoming indispensable intelligence partners, not just transaction facilitators.
That's the pivot. And this move has huge positive implications for intrinsic value because, again, services revenue is inherently less susceptible to regulatory caps than core interchange fees. It is the company's structural hedge against their single greatest external threat.
So we've painted a picture of near perfection. The moat is wide, the strategy is smart, but a value investor needs quantitative proof that the business quality is real. If the qualitative analysis is correct, the numbers should just scream quality.
And with Mastercard, they absolutely do. Let's start with margins, which are the clearest immediate reflection of that pricing power and operating leverage.
And I find these margins simply stunning for a company of this scale, operating in what's a pretty developed industry.
They are extraordinary. Mastercard consistently maintains operating margins between 57% and 59%. In the second quarter of 2025, that margin expanded a bit to 58.7%.
So think about that efficiency. For every dollar of revenue they bring in, almost 59 cents are left after paying all the operational costs.
It's only possible because of that negligible marginal cost per transaction we talked about. Incremental revenue flows almost entirely to the bottom line, which demonstrates that immense operating leverage.
And the net profit margin is equally impressive, right? Around 45% to 46%.
Right, which is characteristic of a company in a duopoly where competition is rational and pricing power is completely intact. If there were true destructive price competition, those margins would just evaporate.
The ultimate test for a quality compounder, though, is the return on invested capital, or ROIC. This is the metric that tells you how effective management is at turning every dollar of capital they deploy into actual profit. It's the acid test of the moat's durability.
And what are the numbers telling us here?
The trailing 12-month ROIC for Mastercard stands at approximately 44.5%.
Wow.
To give that number some context for the learner, the average company in the S&P 500 generates an ROIC of about 10% to 12%. Mastercard generates over 4 times the average return on every single dollar of capital it deploys.
That divergence is the quantitative proof of the capital light thesis we discussed. They don't need expensive physical assets.
Exactly. They are not beholden to inventory, machinery, or massive factories. Their primary assets are intangible: their brand, their software, their network IP, which do not require constant, massive capital injections. This efficiency is why they are able to compound capital so effectively.
So high profitability is established. Now let's look at growth. Mastercard is a massive company already. What's driving their resilience? They reported TTM net revenue of $31.47 billion, which is growing at 15.6% year over year. That's fast.
It's very fast. And they exhibit this consistent growth multiple over global GDP. They aren't limited to just growing at the rate of the overall economy because they benefit from 3 massive secular tailwinds.
Okay, what are they?
First, just general personal consumption expenditure, or PCE, growth, people buying more stuff over time. Second, and more importantly, is the massive ongoing cash displacement.
Right. Digital payments are still penetrating new, previously cash-dominated areas like B2B transactions, government payments, public transit systems all over the world.
And the third factor is that rapidly expanding service expansion we just covered, the value-added services.
So when you combine PCE growth, cash displacement, and the expansion into high-growth services, you get this powerful tailwind that allows them to sort of shrug off the law of large numbers.
And as we mentioned, during high inflation periods, their revenue actually accelerates automatically as that gross dollar volume swells, which makes them highly resilient across different economic cycles.
Okay, so finally we have to discuss how management handles all this excess cash they're generating, the capital allocation. You refer to Mastercard as a prodigious cannibal, and that's a key factor in their compounding.
It is, and that just means they're very disciplined. They return excess cash to shareholders through aggressive share repurchases when they can't find internal projects that can match their 44% ROIC.
So they literally eat their own shares, which concentrates future earnings among fewer and fewer owners.
And the sources noted a massive new buyback program was authorized recently.
A huge new $14 billion share repurchase program was authorized in late 2025, which signals management's continued commitment to this strategy.
And the effect on the intrinsic value per share is profound. The share count has been systematically reduced from about 1.14 billion in 2015 to roughly 911 million in 2025. That persistent reduction in the denominator is the turbocharger effect.
So even if the net income, the numerator, only grows at 10% next year, because the share count, the denominator, is shrinking, the earnings per share, or EPS, grows at 12% or more.
It's how they compound shareholder wealth faster than the underlying business is actually growing.
Absolutely. And their M&A strategy, as we noted, is highly disciplined. It's focused on strengthening that VAS moat rather than just adding risky volume.
So acquisitions like Recorded Future or the $850 million purchase of Ekata for identity verification, they're strategic. They're helping to avoid diversification, which so often plagues cash-rich companies that just suddenly start buying unrelated, lower-quality businesses.
That's right.
So we've painted a picture of immense strength, but the value investor must always look for the structural risks that could impair the thesis. We established that the single greatest threat is not competition, but regulatory intervention.
Right. These networks are essential infrastructure, which makes them targets for government action aimed at reducing merchant or consumer costs.
And that's the primary structural risk to their economic rent. In the U.S., the big headline threat is the proposed Credit Card Competition Act, or CCCA. We should probably explain what this is and why merchants are so desperate for it.
Let's frame it from the merchant's point of view. Merchants look at that 2% or 3% interchange fee, the fee that's paid to the card issuer when you swipe your card, and they call it a tax on commerce.
A tax they have no choice but to pay.
That's the pain point the CCCA is trying to address. The intent of the proposed U.S. legislation is to introduce competition at the network level for credit cards. It aims to require large banks, the issuers, to enable at least one alternative payment network.
Meaning not Visa or Mastercard.
Meaning not Visa or Mastercard on their credit cards.
And the consequence there would be that merchants could then choose to route transactions via a lower cost, probably smaller network, thereby forcing Mastercard and Visa to compress their immense pricing power.
It theoretically compresses their margins, especially on the transaction processing and domestic assessment fees. However, the analysis notes that the implementation challenges are massive. It is incredibly technically complex to integrate different competing networks, especially when those networks have different liability structures and fraud detection standards.
Which could actually increase system-wide fraud.
Potentially, yeah. But the most important strategic hedge we discussed is Mastercard's proactive pivot.
Right.
That move into unregulated value-added services is management's brilliant strategic hedge against this specific regulatory headwind. By shifting revenue from regulated payment fees to unregulated security and intelligence software, they are future-proofing the business against political intervention that's aimed at capping transaction costs.
Okay, so beyond legislation, let's look at technological disruption, specifically real-time payments, or RTP. This is the idea that new government-backed systems can bypass the card networks entirely, like FedNow in the U.S.
And this risk is not theoretical. It's a present reality in many developing markets. I mean, look at PIX in Brazil or UPI in India.
Okay.
These government-backed rails allow for instant bank-to-bank transfers, often at zero or minimal cost to the user. In Brazil, PIX has seen massive adoption and has demonstrably cannibalized a significant amount of debit transaction volume that might otherwise have flowed over the card networks.
So that is a direct competitive threat to the traditional four-party model.
It is.
So that seems like a massive structural risk. Are they fighting it or are they joining it?
They are absolutely joining it. It's the strategic multi-rail approach. Rather than resisting these new payment innovations, Mastercard is positioning itself as a network of networks. They acquired Vocalink, a key UK-based RTP operator, specifically to gain the expertise and infrastructure to play in this domain. Their goal is to capture the transaction, authenticate it, and add value through their services, fraud detection, data analytics, regardless of whether the final settlement happens on a traditional card rail or a new RTP bank-to-bank rail.
So they aim to sit on top of the payment, providing the security and intelligence layer, even if they aren't providing the underlying pipe.
That's it. They're maintaining the toll bridge, but ensuring it accepts all different kinds of vehicles.
That's a great way to put it.
And it moves them up the value chain to that unregulated, stickier services layer. Finally, we can't ignore economic sensitivity.
Right. While we celebrated the inflation hedge, the business is intrinsically tied to global commerce.
So a major global downturn that significantly reduces consumer spending and cross-border travel, especially that high-margin cross-border segment, would undoubtedly impact their gross dollar volume growth and thus their revenue forecasts.
And for a stock that's currently priced for perfection, any cyclical earnings contraction could be disproportionately punished by the market.
That's the risk.
Okay. We've established the quality of the business and the major risks. Now we have to address the price. Following the value investing framework, we have to calculate the intrinsic value, the discounted value of all the future cash flows that can be taken out of the business over its remaining life.
And we start with the concept of owner earnings.
This is Buffett's definition of true cash generation, which can often differ from the reported net income. Let's walk through the formula simply for the learner.
Sure. Owner earnings is defined as net income, plus non-cash charges like depreciation and amortization, or D&A, minus the small amount of capital expenditures, or CapEx, that's required just to maintain the current competitive position, maintenance CapEx.
So using the TTM data for late 2025, let's plug in the numbers.
Net income was robust, came in at $14.25 billion. Depreciation and amortization were about $900 million. And crucially, capital expenditures, the cash they actually spent on maintaining the business, was very low, around $472 million.
So $14.25 billion plus $0.90 billion minus $0.47 billion gives us approximately $14.68 billion in owner earnings.
And the profound insight here, which really validates that whole capital light thesis, is that their capital expenditures are significantly less than their depreciation.
For most industrial companies, CapEx is equal to or greater than D&A because they have to constantly spend cash to replace physical machinery that's wearing out.
Right. But for a software utility like Mastercard, they are essentially writing off hardware they bought years ago, which is D&A, while only spending minimal cash today, which is CapEx, on system upgrades.
So it confirms that their reported net income is actually a highly reliable and maybe even a conservative proxy for the enormous amount of cash flow the owners can extract.
Exactly.
So now we move to the discounted cash flow model, the DCF, which requires us to define our assumptions about the future. We need to be conservative, but realistic. Let's start with the discount rate. We use 9.0%. Why is that the crucial hurdle rate?
So the discount rate is the rate of return you demand on your investment, factoring in risk and opportunity cost. We set it at 9.0%.
Okay.
This is based on the current 10-year Treasury yield of around 4.2%, plus an equity risk premium which we adjusted slightly lower because of Mastercard's exceptional stability, its duopolistic power, and its pristine balance sheet.
So we're treating Mastercard as a safer equity investment than most.
We are. So next, the growth projections. Analysts are very bullish, forecasting EPS growth of nearly 16% annually.
But we chose to be more conservative than that optimism.
You have to build in a margin of safety in your assumptions. So we assumed a 12% annual growth rate in free cash flow for the first 5 years.
Which is still a high rate.
It's still high, yeah. It reflects the power of the VAS expansion and global cash displacement, but it provides a meaningful cushion against potential regulatory headwinds, like the CCCA actually passing.
And then it tapers off.
We then assumed that growth tapers down linearly, falling to a sustained rate of 8% by year 10, recognizing that the market will inevitably mature.
And finally, the terminal growth rate, which is the perpetual growth rate of the business into eternity.
We set that very conservatively at 3.0%. This is a standard, prudent assumption that aligns with long-term expectations for global GDP and inflation combined. It's a low-risk way to value the endless compounding power of the network.
Okay, so applying that 9.0% discount rate to those projected cash flows gives us the present value of the next 10 years of earnings.
And the sum of the present value of those 10 years of cash flows comes out to $165.4 billion.
Right.
The terminal value calculation is much larger, representing the value of the business into perpetuity. It's $689.33 billion in year 10 money, which when you discount that back to the present at 9.0% equals $291.17 billion.
So summing those components together, the 10-year cash flow present value and the terminal value present value, and adjusting for Mastercard's relatively small net debt position of about $4.2 billion, we arrive at a total equity value of $452.37 billion.
And dividing that total equity value by the roughly 911 million diluted shares outstanding, our base case calculation yields an intrinsic value per share of approximately $496.
All right, now for the moment of truth, the comparison. The current market price for Mastercard is around $570 a share. Our calculated rigorous intrinsic value is $496.
So that means the stock is trading at a roughly 15% premium to our prudent valuation.
This is the market disconnect.
It is. There is currently no margin of safety for the strict value investor. So we have to ask, what is the market pricing in to justify paying $570 per share?
It must be pricing in perfection, or maybe something even better than perfection.
I think that's right. To justify a $570 price tag, the market has to be assuming sustained cash flow growth closer to that analyst forecast of 15% to 16% for the entire decade, not our more conservative 12% tapered assumption. Or they must be treating Mastercard as a bond substitute because of its safety and certainty, which lets them use a much lower discount rate, say 8.0% instead of our 9.0%.
And they must be aggressively factoring in the continued powerful accretive effect of those massive buybacks, the cannibal strategy, which reduces the share count by about 2% a year.
It's a combination of all those things. But if you buy a business at $570 that is only worth $496 based on prudent math, you are not protecting your capital against unforeseen shocks or analysis errors or regulatory surprises.
The intrinsic value framework demands that protective cushion.
It does.
So let's bring it all home. Mastercard is a phenomenal business. It's the definition of a platinum standard compounder. It's protected by a wide, strategically widening moat, pristine financials, and a disciplined management team that knows how to allocate capital efficiently. The quality is simply undeniable.
But the valuation is equally demanding. Our base case, assuming a prudent 9% discount rate and a conservative 12% medium-term growth rate, yields an intrinsic value of $496 per share.
Therefore, the final investment verdict for the strict value investor who requires a margin of safety is that Mastercard is a whole D. We can admire the business, but we have to respect the price and the math.
Right. However, we can identify what an attractive entry point might look like. A pullback into the $450 to $470 range, perhaps triggered by a short-term regulatory scare about the CCCA, or a cyclical decline in that high-margin global travel.
That would present an opportunity to acquire this Tier 1 compounder with the requisite margin of safety we demand.
Exactly.
And that brings us to our final provocative thought for you, the learner. We've analyzed Mastercard as this powerful utility, but its entire strategic pivot is focused on value-added services, unregulated software, data, and cybersecurity intelligence.
So if this strategic pivot successfully transitions Mastercard from being primarily a regulated payment processor to being an unassailable data and cybersecurity partner,
then will traditional financial valuation models, like the DCF we just used, truly capture the value of that growing, unregulated, and exponentially stickier services moat.
And fundamentally, what portion of Mastercard's current regulatory risk is entirely eliminated when the majority of their profitability comes from providing software intelligence rather than mandatory transaction fees.
That's the strategic shift that will truly determine if Mastercard justifies its premium valuation in the decades to come.
Food for thought.
Indeed. We hope you feel significantly more informed about the mechanics and the valuation of this powerful company. We'll see you next time on The Deep Dive.